We are thrilled to have you all join us today for this very critical discussion on climate change and banking, or a bank executive joining us for this focused discussion for today only that will provide actionable insights and foster meaningful dialogue. So let's begin this important conversation. Welcome once again, and let's
On these areas. First of all, we will start with understanding climate change. Wind over hours and days. When we talk about hours and days, it refers to weather many years, and it usually takes hundreds and thousands of years for the climate to change. That is basically what is climate. So climate refers to the average weather conditions over a long period. At Earth's surface, it is reflected back through the atmosphere to the space. So, greenhouse gases trap the heat from the sun in the atmosphere after it is reflected from Earth. So, these greenhouse gases, whatever we discussed, water vapor, carbon dioxide, methane, the oceans would turn to ice and life as we know it would not exist. If you see the main human activities releasing the greenhouse gas in the atmosphere, electricity from coal or diesel generators ranks first, followed by industry or pollution from factories. More greenhouse gases trap more heat in the atmosphere, leading to global warming. Over millions of years, species become adapted to survive in the conditions in which they live. Rising temperatures are causing sea levels to increase. Ice sheets and glaciers melt, resulting in addition of fresh water to the ocean. 2010, then the white ice shows the minimum sea ice coverage in 2020. The difference between the two exceeds 1 million miles. We may think zero point 0.5 degrees centigrade increase in global temperature, very small, 1 degree is very small. No, it makes a lot of difference. If you see like that, millions of species loss. So it percentage species loss will be insects 6 to 18%, plants 8 to 16%, and vertebrates 4 to 8%. Rise in the sea level from 48 centimeters to 56 centimeters to the climate change. Burning fossil fuels, deforestation, reduction of biodiversity, these are causing the climate change. Because poorer countries are less able to adapt to climate change, therefore suffer the most from its effects. That's why all the countries have to put efforts to keep the temperature rise. It is a pressing crisis that impacts every part of our lives. First one, biodiversity, its impact on biodiversity. Heat waves. Heat waves are becoming more frequent and intense. These extreme weather events pose serious health risks, strain water supplies, and reduce agricultural productivity, affecting food security. So these are the important harmful hazards the climate change is causing. Over the last decade, the highest number of deaths due to floods in India has happened in 2010 with a total toll of about 1,000 people. 2024 was the warmest year in India since the beginning of 20th century, growing at a faster rate, resulting in the climate change, high emissions in the country, because our main reliance on coal and the most polluting fossils, it is the most polluting fossils fuel. So India's carbon dioxide emissions from the coal totaled roughly about 2 billion metric tons in 2023. India has committed for various targets as it works towards tackling climate change transition, but there are so many hurdles to overcome in balancing the development's needs with the environmental concerns. Physical risks, it refers to the economic cost and financial losses resulting from the increasing frequency and severity of chronic flooding on land sites may present a risk to the value of our collaterals, including changes in the climate related policies and regulations, the emergence of newer technology, shifting sentiments and behavior of customers. So, the drivers of transition risks are climate related mitigation policies, technological advances, shifts in the public sentiment. So, what are the various prudential risk categories? And also need to take into account these risks while preparing our internal capital adequacy statements, assessment pass processes, that is ICAP document under Pillar 2 of the Basel 3. Although there is a high degree of certainty that some combination of physical and transitional risk will materialize in future, so three things: far-reaching, inadequate capture of future impact, our banks, financial institutions, financial market participants, firms, households, governments, and sectoral regulators are crucial for the taking steps to understand the position of the impact of the climate change in Indian banking industry. Many industries will have to find an alternative way to sustain themselves in the coming days. Bank credit published by RBI during January 2024, the and it so the major one of the major around 12 to 13% of the so the banking exposure, particularly when we come to discuss about the infrastructure, physically climate change, rising sea levels, frequent storms, landslides, and other extreme trade weather events, and our Indian banks will need to make changes in their coal is being used for producing the industry energy because coal is available in abundance. The industries and sectors that seem to be at higher risk are agriculture, food processing, construction, infrastructure, and tourism. So we should be very, very careful. And while doing so, the various microeconomic and macroeconomic channels of climate risk. So in a chronic event like this, the borrower may not be able to repay the debt, and automatically it will result in the negatively impacting their ability to repay the loans. So this type of events would increase the credit risks for the banks. Or reduced income of corporation would impact the tax income of the sovereigns, and this may impact the overall health of the economy. This may result in an increased gap in spending and income. Now, let us see what are the regulatory landscape and the compliance in India. Climate risk and integration in banking. Banks must integrate the climate risk assessment into their risk management framework. So, compliance requirements for banks to ensure compliance, financial institutions, including banks, should report ESG performance, recognized framework for climate risk reporting. It has four core areas: governance, strategy, risk management, metrics, and targets. So this is how to be implemented. Will and Indian regulators are increasingly investors and stakeholders demand greater transparency on climate risk and making TCFD compliance essential for long-term resilience. We are all aware existing Basel guidelines address three important anchors points in the banking industry. They are minimum capital requirement, supervisory review process, market discipline, regulatory guidelines. In continuation with the practice of setting the path ahead, later on, it has also issued a newsletter addressing the need to implement the principles by respective banking regulators in the countries. So, Reserve Bank of India has also came out with a broad guidelines for the Indian banks. Carbon risk-weighted assets they may stipulate expansion of green priority sector categories also to include the electric vehicles and circular economy projects, data limitations, high cost of compliance, limited awareness and expertise.
So this happens to be the last webinar for Stream 1 during this calendar, this webinar calendar. Monetary policy, which will be announced by the MPC, and it is very important also because that will be the first. We are trying to increase our membership, and I will request you all to contribute in increasing the membership of the club.
Coming to the risk identification, this is the first step. Recognizing the climate risks affecting the bank's operations, loan portfolios, investment strategies. As we discussed earlier, they are physical risks. So the most important point here is to integrate the climate related financial risks for green financing, moving towards a low carbon economy and mitigating the transition risks. Loan to value ratios, how it will impact. Suppose assess the impact on loan to value ratio for real estate loans in flood prone areas, expected credit losses, develop structured financial products like green bonds and sustainability linked loans, require high risk borrowers to implement climate adaptation strategies, ensure integration of climate risk into enterprise wide risk management, then policy and framework development. So, regular climate risk assessments using various risk models and stress tests, climate action plans, as we discuss it as suggested by the TCFD or Global Reporting Initiative or Sustainability Accounting Standard Board, then their transparency with investors will increase and they will be able to make better decisions. Some banks are adopting globally or suggestive measures how successful to be the six climate risk management has been suggested in this risk management. Company owned vehicles, on-site data centers, scope 1 emissions are relatively very low compared to other sectors. So they can be controlled very easily. Scope 3, indirect emissions in the value chain, most significant for our banks. So banks are critical enablers for the transition to low carbon economy while assessing the various risk and various activities of the banks. So embedding the climate risk into credit risk management is very important. Transmission channels such as macroeconomic, microeconomic, capital depreciation, new customer preferences, and business disruptions. So, first and foremost, in the strategy and products, having done this, they have to translate the overarching credit business strategy and product focus into appropriate risk appetite and also establish green lending products and portfolio targets. That is what the first step of the strategy and the products. Second step is prospecting and origination. So we have to define the target clients and perform due diligence. Of shorter term nature poses the challenges. However, portfolio. Continuous monitoring and innovation in methodologies are essential. Once stress management is over, then default management. Managing defaults and problem effects and manage recoveries. So impact of climate on loss realization also be assessed. Report credit risk processes and outcomes to various stakeholders. We are far behind on financing green energy, only a meager 7,700 crores out of 1,76,000 crores, 1 crore 76 lakhs crores. It is very minuscule. So climate change look manageable due to insurance coverage. However,
First of all, I invite our senior mentor, Kansale sir, for his observations. Kansale sir.
And because of the climate risk, your industry may get impacted. If we are adding to the climate risk by ignoring what your customer is doing, that is also wrong. And if we are ignoring that customer is not respecting the possible climate risk, that is also wrong. No doubt, there are two important things which have to bear in mind. I mean, a chapter on what are the possible risks and what are the mitigants that this industry is going to ensure so that they do not create the climate risk and they are not impacted because of climate risk. I think that is all from my side. Thank you.
Good afternoon. Thank you. Thank you very much. This is a very comprehensive presentation. I think you have taken quite some time to collect all the information and to put it across. The progress with respect to reducing this, carbon emission, around 50% capability is renewable energy, not go in a big way to impose kind of a regulatory requirement too strict and so that the credit dispensation will be adversely affected.
Mr. Umesh Joshi, you want to say something? Please continue.
And this carbon credit was tradable in the global trade. Now it is going to be tradable here in India.
And I also thank Gonzalez sir and Puri sir for their valuable additions to this discussion. And I'll remind all the attendees that the video recording of this webinar, along with detailed webinar summary highlights and key takeaways and ebook, I'll request them to consider becoming a regular member of Elite Bankers Club